जी बिजनेस में आपका बहुत स्वागत है। मैं हूं ब्रिजेश और हम आपको बता दें कि अब से थोड़ी देर में कंपनी के इतिहास में पहली बार बर्कशायर हैथवे की एजीएम की बैठक को पूरी दुनिया में लाइव स्ट्रीमिंग के तौर पर दिखाया जा रहा है। अब से थोड़ी देर में कंपनी के चेयरमैन और सीईओ वॉरेन बफे शेयर होल्डर्स को संबोधित करेंगे। एजीएम में बफे मार्केट, बाजार और अर्थव्यवस्था पर अपने विचार रखेंगे। आप सीधी तस्वीरें देख रहे हैं।
You may notice in the movie, incidentally, that Charlie is always the one that gets the girl. And he has one explanation for that, but I think mine is more accurate. That, as you know, every mother in this country tells her daughter at an early age, if you're choosing between two very old and very rich guys, pick the one that's older. I'd especially, we're webcasting this for the first time, so I'd especially like to welcome our visitors from all over the world. We're having this meeting simultaneously translated into Mandarin, and that poses certain problems for me and Charlie because I'm not sure how sensible all our comments will come out once translated into Mandarin. In fact, I'm not so sure how sensible they come out initially sometimes, but we're delighted to have people around the world joining us. Now, the drill today is that I'll make a couple of introductions and we'll show a couple of slides, and then we'll go on to questions from both our two panels and from the audience. We'll rotate them. And we'll do that until about noon. Actually, about 11:15, I'll give you a rundown on a bet that was made that we report on every year. But then I'll also, in connection with that, explain, and it ties in with it, what I really think is probably the most important investment lesson in the world. So we'll have that about 11:15. And I hope that keeps you around. And then we'll break at noon for an hour for lunch. We'll reconvene at 1 o'clock. We'll proceed until 3:30 with questions. We'll then adjourn for 15 minutes, and at 3:45 convene the formal meeting. I'd like to just make a couple of introductions. I hope Carrie Silva is here. Do we have a spotlight? Carrie puts this whole meeting together. There she is, Wonder Woman. Carrie joined us. Carrie joined us as a receptionist about 6 years ago, and I just kept throwing more and more problems at her. And she put together the 50th anniversary book, which we've actually expanded further this year. We have a revised edition. Charlie and I autographed 100 of them. We interspersed them among the group being sold. And Carrie, while doing that, she also had a young baby girl, her second baby, late in January. But then she's gone ahead to put on this whole annual meeting. It's a remarkable achievement, and I really want to thank her. It's been terrific. Actually, we have one surprise guest. I think my youngest great-grandchild, who will be about 7 months old, is also here today. And if he happens to break out crying a lot, and don't let it bother you, it's just his mother's explaining to him my views on inherited wealth. And we also have our directors with us, and they're here in the front row. I'll introduce them if they'll stand when introduced. Withhold your applause, no matter how extreme the urge to applaud them individually. And when we finished, then you can go wild. First of all, Howard Buffett, Steve Burke, Sue Decker, Bill Gates, Sandy Gottesman, Charlotte Guyman, Tom Murphy, Ron Olson, Walter Scott, and Merle Whitmer. And that's our wonderful group. Now we just have 2 slides to show you now. The first one is a preliminary summary figures for the first quarter. And you'll notice that insurance underwriting, these are after-tax figures by category, are down somewhat. The basic underwriting at GEICO is actually improving, but we had some important hailstorms in Texas toward the end of the quarter. We've actually had some since the end of the quarter too. So there were more cat losses in the first quarter than last year. And the railroad earnings are down significantly, and railroad car loadings throughout the industry, all of the major railroads, were down significantly in the first quarter, and probably will continue to be down, almost certainly will continue to be down the balance of the year. We have 2 companies which we added to the manufacturing, service, and retailing field, Precision Castparts and Duracell, but they were added during the quarter, so their full earnings aren't shown in the figures. In the other category, we have, I don't like to get too technical here, and you should read the 10Q when it comes out next weekend. But when we borrow money in other currencies, and the only currency we've done that with is the euro, but we have a fair amount of money that we borrowed in euros, and the nature of accounting is that the change in value, the foreign exchange change in value each quarter, is actually shown in interest expense. So if the euro goes up, we have a lot of extra interest expense, or it's shown that way. It's not a realized factor, but it moves from quarter to quarter. And if the euro goes down, it offsets interest expense. It's a technicality to some extent because we have lots of assets in Europe, and they're expressed in euros. When they go up, it does not go through the income account. It goes directly to other comprehensive income. So that figure, which looks a little unusual, that's the reason for it. And we always urge you to pay no attention to the figures below operating earnings. That they will bounce around from quarter to quarter, and we make no attempt to manage earnings in any way, to have them be smoother. We could do that very easily, but it'd be ridiculous. We make investment decisions solely on the basis of what we think the best investment decision is, not on the basis of how it will affect earnings in any quarter or in any year. And in the first quarter, we completed a transaction that was begun over a year ago, whereby we exchanged our Procter & Gamble stock for cash and for Duracell, and that largely accounts for the large capital gain in the quarter. So those are the figures for the first quarter. And then to illustrate what we're sort of all about here, I put up a second slide, and I started this slide in 1999. The reason being that at the end of 1998, we effected a large merger with Gen Re, and at that point we sort of entered a different era. After 1998 merger with Gen Re, we had a little over 1,500,000 and some thousand A equivalent shares out, and our shares up to that point, we'd increased the outstanding shares by more than 50% over the 30-some years preceding that point. Since that time, as I note here, we've only increased the number of shares over the next 17 years. We've only increased the shares outstanding by 8.2%. So these figures represent a fairly unchanged share count since that point, whereas the share count had changed quite a bit before. And as you'll note, in terms of operations, I've told you that our goal at Berkshire is to increase the normalized earnings, operating earnings, every year. And I've said sometimes we hope it'll turn out to be only a little bit, and sometimes we can get some fairly decent jumps. But that's the goal. Now, earnings will not increase every year because there's such a thing as a business cycle, and in times of recession, we're going to earn less money, obviously, than in times when things are much better overall. And on top of that, we're heavily in an insurance business, and earnings there can be quite volatile because of catastrophes. And this chart shows you what's happened to the operating earnings since that time. Again, pointing out that shares outstanding have gone up very little during that period. You'll notice in 2001, when we suffered significant insurance losses due to 9/11, we actually were in the red in terms of operating earnings. And you'll notice the figures are very irregular, but over time, by adding new subsidiaries, by further developing the businesses we have, by bolt-on acquisitions, by the reinvestment of retained earnings, the earnings have moved up in a very irregular fashion quite substantially. I put in also the capital gains we've achieved through investments in derivatives, and they total some $32 billion after tax, close to $50 billion pre-tax. Those are not important in any given year. Those numbers can go all over the place. The main advantage from my standpoint in that $32 billion is it gives us money to buy other businesses. What we really want to focus on, what we hope, is that the bigger under operations 5 or 10 or 20 years from now grows substantially, partly because we retain earnings from operations, partly because our operations improve in their own profitability, partly because they make bolt-on acquisitions, partly because we have gains from securities which enable us to buy even more businesses. But we don't manage, as you know, we don't manage to try to get any given number from quarter to quarter. We never make a forecast on earnings. We don't give out earnings guidance. We think it's silly. We do not have budgets at the parent company level. Most of our subsidiaries have budgets, but they don't submit them, or they're not required to submit them to headquarters. We just focus day after day, year after year, decade after decade on trying to add earning power, sustainable and growing earning power to Berkshire. So that's a quick summary. Now we'll move on to the questions. I just ask that with the audience that you limit your question to one question. The multiple questions have a way of sneaking in occasionally. So let's keep them to a single question. We'll start off with the journalist group on my right, and we'll start off with Carol Loomis.
Good morning. I'll make my very short a little speech about the fact that the journalists and the analysts, too, have given Charlie and Warren no hint of what they're going to ask. So they will be learning for the first time what that's going to be also. This question comes from Eli Moises. In your 1987 letter to shareholders, you commented on the kind of companies Berkshire liked to buy, those that required only small amounts of capital. You said, quote, "Because so little capital is required to run these businesses, they can grow while concurrently making almost all of their earnings available for deployment in new opportunities." Today, the company has changed its strategy. It now invests in companies that need tons of capital expenditures, are overregulated, and earn lower returns on equity capital. Why did this happen?
Yeah, well, it's one of the problems of prosperity. The ideal business is one that takes no capital, but yet grows. And there are a few businesses like that, and we own some. But we are not able, we'd love to find one that we could buy for 10 or 20 or $30 billion that was not capital intensive. And we may, but it's harder, and that does hurt us in terms of compounding earnings growth. Because obviously, if you have a business that grows and gives you a lot of money every year and doesn't take it, it isn't required in its growth, you get a double-barreled effect from the earnings growth that occurs internally without the use of capital, and then you get the capital it produces to go and buy other businesses. And See's Candy was a good example of that. I've used that. Back when the newspaper business was good, our Buffalo newspaper, for example, was a good example of that. The Buffalo newspaper was making, at one time, $40 million a year and had no capital requirements. So we could take that whole $40 million and go buy something else with it. But increasing capital acts as an anchor on returns in many ways, and one of the ways is that it drives us into, just in terms of availability, it drives us into businesses that are much more capital intensive. You just saw a slide, for example, on Berkshire Hathaway Energy, where we just announced, just in the last couple of weeks, we announced a $3.6 billion investment coming up in wind generation. And we pledged overall to have $30 billion in renewables. Anything that Berkshire Hathaway Energy does, anything that BNSF does, takes lots of money. We get decent returns on capital, but we don't get the extraordinary returns on capital that we've been able to get in some of the businesses we require that are not capital intensive. As I mentioned in the annual report, we have a few businesses that actually earn 100% a year on true invested capital. And clearly that's a different sort of operation than something like Berkshire Hathaway Energy, which may earn 11 or 12% on capital, and that's a very decent return. But it's a different sort of animal than the business that is very low capital intensity. Charlie?
Well, when our circumstances changed, we changed our minds.
Slowly and reluctantly.
In the early days, quite a few times we bought a business that was soon producing 100% per annum on what we paid for it and didn't require much reinvestment. If we'd been able to continue doing that, we would have loved to do it. But when we couldn't, we went to Plan B. And Plan B is working pretty well, and in many ways I've gotten so I sort of prefer it. How about you, Warren?
Yeah, that's true. When something's forced on you, you might as well prefer it. We knew that was going to happen, and the question is, does it lead you from what is a sensational result to a satisfactory result? And we're quite happy with a satisfactory result. The alternative would be to go back to working with very tiny sums of money, and that really hasn't gotten a lot of serious discussion between Charlie and me. Okay, from the analyst group, Jonathan Brandt.
Hi, Warren. Thanks for having me again.
Thanks for coming.
My first question is about Precision Castparts. Besides your confidence in its talented CEO, Mark Donegan, What in particular do you like about their business that gave you the confidence to pay a historically high multiple? Are there ways Precision can be even more successful as essentially a private company? For instance, are there long-term investments to support client programs or acquisitions that Precision can make now that they couldn't realistically have done as a publicly traded entity?
Yeah, we completed the acquisition of Precision Cash Parts at the end of January this year. We made the deal last August, and you covered the most important asset in your question. Mark Donegan, who runs Precision Cash Parts, is an extraordinary manager. I mean, Charlie and I have seen a lot of managers over the years, and I would almost rank Mark as one of a kind. I mean, he is doing extremely important work in terms of primarily making aircraft parts. I would say that there's certainly no disadvantages to him to be working as and for that company to be a subsidiary of Berkshire and not be a public company. And I think he would say, and I think Charlie and I would agree with him, that over time there could be some significant advantages. For one thing, he can spend 100% of his time now on figuring out better things to do with aircraft engines. And it was always his first love to be thinking about that, and he did spend most of his time, but he also had to spend some time, explaining quarterly earnings to analysts and perhaps negotiating bank lines and that sort of thing. So his time, like all of our managers, can be spent exactly on what makes the most sense to them in their business. Mark does not have to come ever to Omaha to put on some show for me in terms of justifying $1 billion acquisition or planned investment. He doesn't have to waste his time on anything that isn't productive. And running a public company, you do waste your time on quite a bit of stuff that isn't productive. So I would say we've taken the main asset of Precision Cast and made him, in this case, even more valuable to the company. In terms of acquisitions, Precision's always made a number of them, but as being part of Berkshire, there's really no limitations on what can be done. So there again, his canvas has been broadened, enlarged with the acquisition by Berkshire. I see no downside whatsoever. If he needs capital, I've got an 800 number, and he wasn't paying much of a dividend before, but he doesn't have to pay any dividend now. And Precision Cash will do better under Berkshire than it would have independently, although it would have done very, very well independently. Charlie?
Yeah, well, in the early days, we used to make wise-ass remarks. And Warren would say, we buy a business that an idiot could manage because sooner or later an idiot will. And we did buy some businesses like that in the early days, and they were widely available. Of course, we'd prefer to do that. But the world has gotten harder, and we had to learn new and more powerful ways of operating. A business like Precision Cast Parts requires a very superior management that's going to stay superior for a long time. And we gradually have done more and more and more of that, and it's simply amazing how well it works. I think to some extent we've gotten almost as good at picking the superior managers as we were in the old days of picking the no-brainer businesses.
Yeah, we would love to we won't be able to find them because they're very rare birds, but we would love to find another 3 or 4 of a similar type to Precision Cast Parts, where they forever are going to be producing something where quality is enormously important, where the customers depend very heavily on them, when there's contracts that extend over many years, and where people don't simply just take the low bid in order to get this gadget of one sort or another. it's very important that you have somebody there that has enormous skill running the business, and their reputation among aircraft manufacturers, engine manufacturers, is absolutely unparalleled. Okay, now we go to the audience, and we'll go up to section 1. And if you'll give your name and where you're from, I'd appreciate it.
Hi, good morning. My name is Gaspar. I'm Spanish, and I come from London. I admire you both in many ways, but I would like to know that when looking backwards, what would you have done differently in life in your search for happiness?
Well, I'm 85, and I can't imagine anybody any happier than I am. So, by accident or whatever, I'm sitting here eating exactly what I like to eat, doing in life exactly what I love to do with people I love. So it really doesn't get any better than that. And I did decide fairly early in life that my favorite employer was myself, and I think that presented. I've managed to avoid really aggravation of almost any sort. Really, if you or those around you that you love have health problems or something, I mean, that is a real tragedy, and there's not much you can do about it except it. But Charlie and I have really been blessed. I mean, here Charlie is 92, 85, and he's doing every day something that he finds fascinating. I think he probably finds what he is doing at 92 as interesting, as fascinating, as rewarding, as socially productive, as any period you could pick in his life. And so we've been extraordinarily lucky. We've been, we're lucky it's a partnership. It's more fun doing things as a partnership. So I've got no complaints. It'd be very churlish of me to have any kind of complaint. And I would say if you're talking about business life, I don't think I would have started with a textile company. Charlie?
Well, looking back, I don't regret that I didn't make more money or become better known or any of those things. I do regret that I didn't wise up as fast as I could have. But there's a blessing in that too. Now that I'm 92, I still have a lot of ignorance left to work on.
Okay, Becky, quick.
This question comes from Solomon Ackerman, who's in Frankfurt, Germany. He wants to know why Berkshire has significantly sold down their holdings in Munich Re, which is the world's biggest reinsurance company based in Germany, while sticking with their reinsurance operations within Berkshire, like Berkshire Hathaway Reinsurance and General Re. Would you reduce exposure to Berkshire Hathaway Reinsurance and General Re if they were listed companies? And he's hoping that this can bring out some of your insights as to what's happening in the reinsurance business right now.